Hey traders, this is Blake Morrow with ForexAnalytix, and you're listening to the week ahead video for October 10th, 2021. Hope you guys and gals are enjoying your weekend. I got a lot to talk about this week. We're seeing a lot of volatility, and I think we're going to see some continued volatility moving forward. I was actually just doing an interview on the Trader Summit site at the end of this last week, and I had a gentleman that, he reminded me, hey, this is the 42-year anniversary of the 1987 crash, October 19th. And he's like, it's coming up. And I'm like, oh, yeah. Those anniversaries, they usually don't freak me out. And it's not this time around. It just reminds me that this time of the year, in October, this is where we get a lot of volatility. Volatility can be a good, up or down. It's not, universally down. It's just increased volatility makes it good for you and I as traders. So that's something that we really have to look forward to. The increased volatility gives us a lot more opportunities as traders. Speaking of opportunities, you guys have to bear with me here. We're going to talk about ForexAnalytix and the price discount that we have right now for the beginning of trading season offer. This offer is only valid going into the end of this weekend, so you got to take advantage of it. If you guys watch these videos all the time, we don't offer discounted rates all the time. Periodically, a couple of times throughout the year. This is one of them. It is over this weekend. Buy 1 month, get 1 month free for the full package of ForexAnalytix. Buy 6 months for the price of 4. Buy a yearly or annual subscription for the price of 7. A lot of people do that because obviously the discount, and we've been around for years and people know who we are. So if you want to take advantage of it, do it. This is the time to do it. Let me tell you what you get though. You get a mobile app. It gives you notifications on the fly. You get updates. You get the advanced analysis with the premium version. You get to listen to all of our webinars that we do, not just the free F.A.C.E webinar for everybody. You get the morning edge, the daily roundup, the European crossover. So you get all this analysis for a very discounted amount. So take advantage of it. I hope you do. And I'm going to take you through the markets. And by the way, and I didn't even talk about the desktop application, the data flash that we give to all of our users, the live squawk, live news that's coming through. The calendars, all the analysis that, the advanced analysis, harmonic Elliott wave. I can go on and on and on. But you know what I'm going to talk about right now? Before I actually talk about what's happening this next week, which by the way, we have inflation data coming up, which, the market's actually paying close attention to. The Fed, we know what to expect out of the Fed. We've been talking about that for the last couple of weeks. That's why the non-farm payroll that you saw this last Friday, even though it was a miss, we still bought the dollar on the dip, right? Because we know what the Fed's expecting. And if you were listening into the free F.A.C.E webinars this week, you knew that already. But I actually want to talk to you about making a bad trade. I'm going to tell you about what I did with the Canadian yen this week. All right. And I'm going to tell you how I approached it, and I'm going to tell you what happened to me. And, it's interesting. 25 years of trading experience, roughly, almost. Well, I started in 96, but I started trading in 96, really started in the business in 95. So, we're talking however many years that is. Look, I still make mistakes as a trader, and we all do. It's constant learning, right? But a lot of times your mistakes are a reminder. So you don't do it all the time. And that's an example of the Canadian yen. The Canadian yen was an example of me going back to the well a second time when I should have just left it alone for the first trade. And a lot of times, especially for those of you that trade with me in the chat room, know that I get a little nervous about going back to the well for something. Going back, I made a profit there. I'm going to go back again and try to make a profit again in the same pair right after that. That was the case of this trade. So let me tell you how I approached it. So this is the Canadian yen. This is a 4-hour chart. We were hitting the 618 retracement. So basically we were right here. I'm going to show you right where we were at earlier this week. We were right here. We were hitting the 618 retracement. We hit the 8860s, 8870s. I shorted the Canadian yen. The reason why I did that is because we were at the 618 retracement. Relative strength was divergent. I took some profits off the I shorted it right there, and I'm like, the good risk reward, false breakout above these highs, I'm going to take it. So I took it short, made a quick 50, 60 pips. It was great. And then as it started to bounce, I'm like, you know what? That's still a big 618 retracement right here. I'm going to short it again. So we got up to like the 88.30s or whatever. And I was already sitting on profits. I booked them. I shorted it again. And then as we started to get closer to the 618 retracement, I shorted more. And then as we got to the top of the wedge, I'm like, you know what? It's just a wedge. We're going to probably reverse here. And crude kept knocking its head up against 80. So then what happened on Friday? It broke higher, and I took a loss as it went above this wedge. So not only did I lose the profits that I made on the first time around, I actually ended up net loss in the Canadian yen, which really disrupted my week. I had a really good week of trading minus that trade. And because of that trade, my week was like, I still made money, but it was very little. And I really could have had a great week last week. So that's just evidence of, making I shouldn't go back to the well. A lot of times I just don't. If I make a good trade the first time around, I'm like, I tend to start looking for different opportunities, not in the same currency pair. So that's just, and that's more of a personal rule. And sometimes you need to take a loss. So you refresh those rules going into the next few months or whatever it is. All right. So let's talk about the dollar index. And this is kind of my approach with the dollar index. So first and foremost, let me get rid of these blue arrows here. I put them there on the Morning Edge webinar, on Friday. But I want to talk about the dollar index. Do you notice the dollar index is right up against major resistance? Okay. It is up against a 38% retracement of the post-COVID drop. Okay. We're knocking our head up against what could be a big reversal for the dollar. I made a big stink about this last week, and I'm going to continue to make a stink about it now, because the thing about a 38% retracement, the 38% retracement determines if a currency pair is going to be an AB equals CD type of move, which this would be the A, B, C, D. We could be trading at closer to 80 in the dollar index if we can hold this 38% retracement. But if we get above that 38% retracement, the chances of now a consolidation would be much higher. So it's interesting with stocks where they're at, the dollar continues to hold up there. And you know why? It's because we are one of the major central banks that are going to be moving rates. Now, probably first. And that is going to probably squeeze some dollar shorts. And I know there are other central banks that are starting to raise rates, but when you're talking about the US, the world's largest economy, starting to move rates or taper and making that move before the ECB, quite possibly before the Bank of England, that, and you got the PBOC, which is probably looking to add more liquidity. Look, the dollar index could be poised to squeeze, and we get above 94.50, 95, and we're really going to squeeze. And why do I say 95? Well, let's go intraday, and not intraday. Let's go back to the daily chart, zoom in a little bit. This high right here back in September, this is 94.75, right? 94.75. The high here is 94.50. The 38% retracement is the 94.50 level. So we really, if we get a daily close above 94.75, closer to 95, that's going to be bullish. And I'll tell you what, I wouldn't want to be short the dollar in that situation. I really, really would not want to be short the dollar if we start getting daily closes above this big resistance level. Just think about that moving forward. Now, next week, we've got some pretty important data. We've got inflation data, right? See, we already know what the Fed's going to do as far as tapering goes. And I was talking with Jim Welsh of Macrotides at the end of this last week. And, he was like, hey, as far as looking at the central bank, inflation is going to matter more for tapering. rates are going to matter. Jobs reports are going to matter more for interest rates moving forward. So he's like, as long as, the jobs reports continue to stay positive, that's going to keep rate expectations, moving higher into 2022, 2023. But inflation data may alter the timeline a little bit, since the Fed is very sensitive to inflation right now. It may influence the pace of tapering. So with CPI coming out on Wednesday of this week, we have producer prices coming out on Thursday. It's going to be very interesting and very important to watch the inflation data moving forward over the course of the last or over the course of this next week. We do actually have retail sales that's coming out on Friday. The reason why that's so important is because we have to see how the consumer is absorbing these higher energy costs. Here we are moving into the fall. And as we move into the fall, we're going to have higher energy costs for a lot of the world as things start to cool down. Especially if you talk about Europe, with natural gas prices, with crude oil prices moving higher. It's going to be interesting to see how the market or how the consumer starts to respond globally. I want to take you to another currency pair really quick. I know I talked about the dollar index. We should talk about the euro really quick, which, by the way, continues to stay bearish. As long as we stay below, 116.50 and 116 right here. I say 116.50 because that's that blue, you can see resistance zone. But really, these spike lows back over here is 116.05, 116.10. But you can see how we've just probed up there. As long as we stay below this level, right around here, I wouldn't be too worried about the euro. The euro is still trading really heavy, okay? And really the targets come in at 115, 114.50. So, still another 100, 150 pips lower. But I want to talk about the dollar Mexican peso. I know I've talked a lot about this over the course of the last few weeks. Last week on the week ahead video, we talked about this being the volatility indicator of the currency market, the VIX, right? And you remember I matched this chart with here's the dollar Mexican peso. Let's go ahead and compare that to volatility. And you can see, that, the dollar Mexican peso is very, very matched up with volatility. Here we go, volatility slumping over the course of the last couple of days, but notice how the dollar Mexican peso is holding up. What I think is happening here is the dollar Mexican peso is telling us there's something brewing in the market. Now, when I talk about in the market, well, what I mean is by the broad equity market. So here's the S&P, right? The S&P, we've come out of this ascending wedge. Here's volatility down here in turquoise. Here's the S&P. We're making a wedge. And let's zoom in, and I'm going to get rid of volatility really quick. Okay, let's just remove that. There's the ascending wedge. We're in another wedge, but we're at the upper end of the wedge right now on the S&P. So as long as we trade below 44.30, 44.40, somewhere around that neighborhood, the S&P looks like we're going to come back down towards 4,300, 4,270. This is a major breakout point. We've been referencing this in our daily webinars, how important that is at the 4,250, 4,270 level. We start breaking below that, then you're going to get a lot of people that have been trying to play the S&P bullishly, right? You're going to actually get them to start to, be aware of potential stop loss orders getting triggered if we get below 42.50. And see, the dollar Mexican peso, because it's so perky right now and because it's held up so well, my thinking is, I know a lot of people are Pavlovian conditioned to just buy dips in the S&P because it's worked for so many years, right? So what's going to happen, in my opinion, is if we get back down to the support, you're going to see probably a swath of buying coming in. But what happens if that buy the dip behavior stops working? How about if the dog continues to come back to the dog bowl at a certain time drooling and realizes there's no food there? What happens then? That's when the owner gets its finger bit off. Yeah, possible. I have 3 dogs, so yeah, it is possible. And my dogs do have a lot of Pavlovian behavior, just so you know. Anyway, that's just some food for thought going into this next week. And look, if you guys like the analysis that I'm providing here, come join us every day on the F.A.C.E webinar. It's free. The link is down below in the description of this video. Just register. It's a Zoom call. You can be on it every single day. You can watch us on YouTube if you want live, if you want to do it there. Make sure you give us a thumbs up if you're watching us on YouTube. And, you know, that just tells me, hey, I'm enjoying the videos, and thank you very much for doing them on a Saturday, because that's what I'm doing. And our team really appreciates it as well. So guys and gals, if you've enjoyed this, I appreciate it, and I really want to thank you for spending your time with me. This next week should be pretty exciting. I'm looking forward to seeing you on the F.A.C.E webinar, and make sure you take advantage of the pricing discount that we have at ForexAnalytix. I'll talk to you next week, or I'll see you on Monday. My name is Blake Morrow. I'm out.